Good afternoon, and welcome to the second part of our joint LCP and Gowlings WLG webinar, titled ESG Implementation, Challenges and Practical Solutions. My name is Alex Waite, I'm a partner at LCP, and I'm going to be chairing this webinar on an issue which seems to be really quickly rising up the agenda, both for pension trustees and also for corporate sponsors. I'm delighted that we've got practitioners here with us today from both the trustee and the investment perspective, and we've also got advisors from both the legal and consulting world, so we can benefit from a full 360-degree view on ESG matters. I will introduce the panel in just a moment. Today we're going to be adopting a Q&A format based on BBC Question Time, and I'm channeling Sir Robin Day, including with a spotty bow tie. Don't worry, this is not the new LCP official dress code. Let me start by explaining the desktop that you'll see in front of you. As well as a video of myself and the other speakers, you should have an image of the slides, which currently shows some windmills. That's where we'll be putting up the question as we answer it. And also, in tune with the question time format, I've asked our speakers to keep visual aids to a minimum, but if there is a particularly useful visual aid or graphic, then we'll put it up in that space. Most importantly, there is a Q&A box where you can please enter a question for the panel, and I will endeavour to keep an eye on that and ask your questions as we go through. There's also a resources panel where you can find links to various related documents on the web. Finally, there's a full bio for each of our speakers and indeed contact details if you want to reach out afterwards. But let me make a quick introduction to each of our speakers today. Jason is an experienced pensions lawyer and head of pensions at Gowling WLG. And he also chaired part one of this webinar series, when we introduced a lot of the jargon behind ESG. We're not going to be explaining that again today, but if you do want to gain a better understanding of any of the terminology that we use, then I recommend you catch up with part one of the webinar, which is still available on the LCP website. Naomi is an independent trustee and managing director at 2020 Trustees. She has a lot of experience in this area. Looking forward to hearing her answers. David is head of responsible investment at USS, one of the largest pension schemes in the UK and one that has taken definitive action in this area. So it should be fascinating to hear his insights. And Ian is a partner in LCP in our investment team and one of our experts in ESG matters. So a warm welcome to all of our panel today. Thank you for answering our questions. Let's move on to those questions. Part one of this webinar, we had a number of people ask us through the portal about how to deal with strong views expressed by pension scheme members. And we have also seen a recent campaign by Richard Curtis called Make My Money Matter. And that, I think, will further motivate members to talk about how their pension money is being invested. As this is something of a minefield for trustees, our first question is on screen now. Do you think that trustees should do more to engage with scheme members on ESG-related matters? And how should trustees go about that engagement process? Jason, I think this is a legal issue to start off with, so perhaps you can kick us off.
Great. Thanks, Alex, and good afternoon, everyone. Yeah, you're right, absolutely. Increasingly, members do have views on climate change and other ESG issues. How their own pension funds are being invested, that is absolutely true. And I would strongly encourage trustees to use all the tools at their disposal to engage with the members. And there are two reasons for doing this, I think. Firstly, to engage members on what you as trustees are doing in terms of integrating ESG risks as a financial factor into your investment decision making. So members are informed and they can comment if they have views on what you're doing and how you're doing it. And secondly, if you want to consider any non-financial factors, such as ethical or moral views. So I think the question for the lawyer really is, well, okay, trustees ought to be engaging, but how do they do that safely and effectively, given the current position under the law? And what I'd just like to bring up is a graphic exercise to sort of take us through the next piece. So if we take a step back a moment and just consider the key legal principles which apply here. The headline to that is that trustees must consider financial factors, and so absolutely to comply with legal duties must see ESG, climate change, responsible investment considered in that financial context, integrated into the overall assessments of financial risk and reward. On the other hand, the law also says that trustees may, but they don't have to take into account the non-financial factors. So, for example, an ethical view about, say, tobacco, coal, gambling. And according to the guidance from various bodies, trustees can only take those non-financial factors into account broadly if two tests are met. Firstly, that trustees can evidence that ethical view is supported by the membership. And secondly, can demonstrate that there's no significant risk of financial detriment posed by the investment. So when you just think about that, how do you actually go about seeing if your membership supports a particular ethical view on, say, gambling to meet that test? What does supported mean? Is it a view agreed by 100% of the members? Well, probably not 100%, but what's acceptable evidence of support? Is it over 50%? If you ran a survey, could you follow the majority who responded? But what if you got some really strong dissenters to that majority? Should you look at a vote by number of people, or do you look at their benefit size? So I think you can see the difficulties that you just need to grapple with. And as a result, I think that trustees need to look at this member engagement question probably slightly differently for DB to DC. So for DB scheme trustees, I'd say that because of what I've just described, particularly because member views will often be couched in terms of those ethical, non-financial factors, it can be quite challenging to give material weight to member views in decision-making, could get trustees into difficult territory. Now, there's an obvious exception, of course, Alex, which is there are schemes that are connected to particular organisations whose own reason for being might be linked to that ethical, moral or religious issue. A charity for environmental protection on climate change might be an example where you might easily be able to say, look, the views of the members of this scheme can reasonably be seen as inferred to being aligned with that of the organisation. But in general terms for DB schemes, I think the better approach is engagement about what actions you're taking in terms of integrating ESG risks as your financial factor. So in other words, the best route for engagement in DB world is to focus on meaningful and engaging disclosure of your approach to ESG matters to the membership and the wider world, and encourage feedback and comments on that disclosure. And we know from the first webinar that we had that the disclosure around all of this, and in particular climate change, is increasing all of the time. So this, I think, offers trustees with DB benefits the real opportunity of engagement through that disclosure. And also in terms of finding an appropriate balance between that engagement, but also not exposing the trustees to an unnecessary level of risk. Now, members may well have views as to how well you as trustees are integrating those ESG risks into your financial assessment. And at the very least, your members ought to be well informed about what you're doing. Now, of course, some trustees of DB schemes might want to engage a bit more proactively, and that's fine, for example, with a survey. So all I'd just say is that they should take care about how they position that in terms of making it clear as to what the fiduciary duties of the trustees are under current law, and that it is a consultation, and that the trustees won't necessarily follow exactly what the members have said. For DC schemes, on the other hand, all of what I've said for DB I think applies, particularly in terms of the default fund, which you can see in much the same way, I think. You know, ESG should be integrated into that from a financial perspective under those basic principles. And as well as through their disclosure requirements I've just described, then I think the need for DC trustees to engage for assessing value for money opens up a natural channel. But of course, there's also scope to be more ambitious in member engagement for DC, particularly in terms of gauging views that enable you as trustees to offer self-select options that meet the wishes of your members. So to wrap up, Alex, I think firstly, yeah, members are absolutely increasingly interested in these ESG issues. They do have more they want to say on them. And absolutely, trustees should engage the members on those issues. But as I say, just need to do that thoughtfully and carefully under the current law, and probably slightly differently for DB and DC.
Makes sense. Thank you, Jason. You mentioned surveys and other ways of engaging. I'm going to ask our audience in a moment what they think is appropriate. Before I do that, Naomi, this must be something you've seen in practice. If you could answer that.
Sure. I agree very much with Jason that asking questions of members can be quite difficult, and I was quite glad when government pulled away from making that compulsory, because my experience of engaging with members is you tend to get a fairly low response in general, whatever you ask, and that the responses are often quite extreme. So on ESG related topics, you'd probably get a number that were passionately for it, but you're bound to get somebody who thought you shouldn't do it at all. And so I think that is quite difficult. But as Jason says, I think particularly with younger members and for DC, there's a huge opportunity around engagement. And I'm just going to put up a slide here if I can make that work. Oh, it doesn't look like it's working. Anyway, it was in relation to some survey results. Oh, there it is. That have been carried out recently. And you'll see of those 5 results there, the 2 at the bottom are the most interesting in this context. So a survey indicated that 50% of the members who responded would contribute more to their DC pot if they knew that the money was being used well for responsible investment. And indeed, 30% would invest in climate-friendly funds, even if this meant lower financial returns, higher cost, or greater risk than traditional funds. And I think that's really important information. But again, as we've talked about, I think the answer is less about asking specific questions to your membership, but more to communicate what you're actually doing and try and show that where you have taken action, for example, to reduce the carbon impact of your funds, that might well make your younger members much more interested in it than they otherwise would be.
Yeah, no, I think that's fascinating. The audience no doubt have their own views on this, so I would like to move now to a polling question. And the question is, which options do you think that trustees should use to engage with scheme members on ESG-related matters? The options should be in front of you now. You can click as many of these as you like, so it's multiple. You can have multiple responses. All member surveys, all member forums, getting together, probably online these days, representatives, member forums, so you're just looking at a subgroup, communicating trustee actions along the lines of what Naomi was just saying, perhaps via a newsletter or other online reports, or other. And if other, I'd be really grateful if you could use that question box to let us know what other you're thinking. When you've selected as many of those as you'd like to select, press the submit button, and we will gather those results in here. And Naomi, I think you were volunteering to do the countdown music, was that right? Yeah. No, you weren't volunteering to do the countdown music. Fine. In that case, we will just, right, can't actually see the results coming in at the moment, but we will move to the results slide, see what responses we've got. Here we go. So coming out top is what Naomi said, so that's really good. 91% communicating what actions have been made. Kind of joint second, all member surveys, more than 50% of people suggesting that, which I think is really interesting. So we've seen happening, but not 50% of people doing that yet. Representative forums, again, seen that happening, but I wouldn't say 50% of schemes are doing it. All member forums, not surprisingly, quite low. One or two people have put in that they have got other. So if you could let us know what other you're recommending, that would be really, really interesting. Let's move on to our next question, because a number of trustees have come under pressure to divest from certain investments, like fossil fuels. And others, as Jason's already mentioned, if they are charities in a particular area, believe they should exclude certain sectors, perhaps tobacco, gambling, or controversial weapons. Now, I know this is an area that has presented legal and practical challenges for trustees. So the question I'd like to ask our panel is, when should trustees exclude certain investments, and what are the practical challenges with doing so? Jason, I think we need to kick off on the legal side again, please.
Okay, yeah, thanks, Alex. So I think it probably is helpful to give just a bit of legal context before David talks about how USIM's gone about this recently. But I think hopefully the audience will just see how David's example will illustrate perfectly some of these points. So the 3 points, I think, by way of introduction are: one, focus on financial factors. So that goes back to what I was saying in answer to the first question. Secondly, to think carefully about definitions. And thirdly, to review periodically. So just briefly on each of those three. So point one, so under the current law, as I've said, the key point remains that you fundamentally need to make these decisions based on financial factors and not non-financial factors. And that takes us then back to drawing on evidence and financial impact analysis on which to base those decisions. You need to remember, of course, that the ESG RI factor influencing financial risk and reward should be considered alongside all the other factors. So this is not just looking at one thing in isolation, but looking at things as a whole. But it has been suggested by many people now that some of the traditional financial models used by markets as a whole may not have taken some of these specific risks, for example, in climate change, into account in the way that they need to. So point one, focus on the financial factors. The second point, if you're going to go for exclusions and screens, you do need to take care, I think, over definitions of those screens. Inevitably, there are grey areas and there's granular detail. So, what should you exclude? Is it producers, users? What about suppliers that enable production? What about companies who have multiple business lines? Do you set a threshold of turnover for what's in and out of the screen? And these are difficult issues. And you need to be clear as you can if you do seek to use the exclusions and screens. And then the third and final point, Alex, is keeping things under review. So as for any sort of trustee decision making and discretion, it is important that you keep the exclusion or the screen under review, probably annually, because the overall risk-reward equation for an investment will change. The factors around the ESG risk might change, the ESG risk might change. So really important for trustees to keep things under review.
Thank you. As you say, this is something of particular relevance to the USS, so I think we skip quickly over to David.
Thanks, Alex, and good afternoon, everyone. Just to start, I need to reiterate the point that all I'm going to discuss going forward is based on a financial analysis of some of these issues. The USS has been, for many years, been asked by certain groups of our members to divest from a range of different companies based on ethical or non-financial issues. In fact, we have our own NGO called Ethics for USS, which has been around since the mid-1990s and still asks us to divest from a range of companies and sectors which they don't think that they should have their pension fund invested in. So earlier this year, USS did make an announcement that we would be divesting from a small number of sectors based on some analysis that we did internally. What we started by doing is identifying some sectors where we didn't think the market was taking into account long-term themes like climate change that could affect the value of our investments. The sectors we identified were thermal coal, certain types of weapons, landmines, cluster bombs, white phosphorus-based weapons, and leaf tobacco manufacturers. 3 different sectors where we thought that analysts and fund managers were simply not building in longer-term risks into their analysis. So what we did is we performed internal teams to undertake that financial analysis. And as an example, I was in the group that analyse our coal investments or the long-term implications for the coal sector, but also in that team were analysts from our emerging markets equities team, our fixed income team, people from our private markets team. So a broad input into that analysis. 3 reports were produced, 1 for each sector, and they were then reviewed by our legal team to make sure that we were in line with the legal points that Jason has just made. The decision has to be made on financial grounds, not on ethical and non-financial grounds. And to reiterate, this because these were investment decisions and investment analysis, that was undertaken by USS Investment Management, the fund manager, wholly owned by USS, the pension fund. So the decisions were made by the fund manager and then reported to our trustee, USS Limited, and the board. And then the decision was taken, we would divest from these 3 sectors, and then you have to go into implementation mode. How do we do this? What we did a review of external service providers. There are a number out there. We chose 2 who could give us the spread of data that we required to look at these 3 sectors. And the detail here is very important. How do you delineate between companies in the same sector? So for coal, we chose thermal coal. Coal can be metallurgical coal as well, that's using steel, but we're not divesting from that. And for thermal coal, we're divesting on the grounds of if they make 25% or more of their revenue from thermal coal, because there are large mining companies out there that have a small proportion of coal in their business, which we don't think is material to their long-term performance. We gave ourselves 2 years to deliver this because it is complicated to get some of these companies out of our holdings, both internal and external, because we then have to come up with agreements with our external managers on how we're going to apply our divestment policies via our external holdings. And as has been pointed out, we will be undertaking annual reviews of the analysis that fed into these divestment decisions, because as Jason pointed out, there could be changes in the issues, changes in the financial performance of those companies that make it that the analysis doesn't apply anymore. A final point is that whatever you do, sometimes your members will not be pleased with what you're doing. As an example, in the last few weeks, we've been approached by our member group telling us that one of the companies, an American bank that we invest in, is supporting thermal coal, therefore we should be divesting from them as well. So there are always more things that your members will be expecting from you. Thanks.
Yeah, if you follow that to its natural conclusion, then you invest in nothing, because everything is related to coal or oil in some way. I think maybe I've misunderstood. Very good. We've got some questions coming in. Would really appreciate it if our audience members could send in a few more questions as well. We'll pick those up in the second half. But I'm going to move swiftly on to talk more about climate change. Obviously, in recent years, we've seen a huge tide of events and highlighted the need to tackle climate change. There's been a lot of societal pressure from high-profile campaigns such as Greta Thunberg, David Attenborough, Extinction Rebellion, etc. And of course, government policy has followed suit. Theresa May promised that we would be net zero by 2050, and that's now enshrined in legislation. And of course, from a pensions perspective, we've got the DWP consultation on managing climate risk as well. So our third of 5 questions is, what are the practical challenges schemes face in seeking to reduce their carbon impact of their portfolios, and how are you going about addressing those? Naomi, can I pass that one to you first?
Absolutely. I'd say the largest challenge up to now has actually been a lack of interest from trustees. I think there's been a bit of a disconnect between the campaigning in the world and the approach of trustees. And I think that's for a number of reasons. A fear of stepping outside the herd, questions over the evidence base. A big issue is confusion with ethical, thinking that climate change issues are an ethical issue, when actually, as we've mentioned several times, this really is about the financial impact. But assuming for the purposes of this that your trustee board has got over that, what practical challenges come in there? Well, I think I've seen quite a bit of hesitation on the part of consultants up to now. Most of them have tended to come to trustee boards with more of a tick box approach to ESG and climate change. They're pretty responsive if you ask the questions, but the trustees need to start by asking those questions and showing genuine interest. I'm delighted to say that things are moving, particularly with investment consultants. And in particular, there's now a new working group on climate change with 12 major investment consultants involved, which includes LCP. And I think that will see some change, but it's still, in my experience, a minority of the consultants who are really engaging on this. So if yours isn't, ask them, because they will then respond. Second aspect is that evidence base, which I think has been quite a big barrier up to now. How could we be certain from a financial perspective that it wasn't going to have a detrimental impact, particularly as the charges do tend to be slightly higher on these funds? Ian dug out for me a really interesting slide, which I'm going to attempt to push to you. This chart shows you on the baseline is a standard global equity index. And then the other lines are a series of different climate change impact, Paris Accord type impact funds. And you will see over the last few years, but particularly this year, those funds really moving away from standard global indices. And I think that's great evidence for us all. As well as that, as Ian talked about in part one, there are some a lot more options in terms of funds, and they can do a lot of. You can approach this in a lot of different ways. There is a fund to suit what your particular scheme appetite is. You might find that your sponsor or your co-trustees are still not keen on taking action. If that's the issue, I would suggest flipping the debate around. Looking at this chart, the evidence is clear now that reducing carbon in portfolios should provide at least the same results with lower financial risk. And in that context, how can you afford not to take action to take a bit of carbon out? I certainly think that the industry up to now has been moving far too slowly relative to the targets that we've got. And in contrast to that, we have an opportunity to make a real difference. And I do think we've got a duty to our members and indeed to their children and grandchildren to help the planet get to the place where it needs to be for us all. But for me, it is about continuous improvement rather than perfection. We can get concerned about knowing all the answers. I always think it's about asking the questions instead. And one way we're seeking to do that with 2020 is asking questions of all our investment consultants and challenges for all our portfolios about levels of carbon. And the way we're looking at that is less about absolute levels, but more about setting challenges for continuous improvement each year. We've written to fund managers asking those questions to say, what have you done in relation to carbon this year? And we're going to ask you next year as well. Now, at the moment, you get 300-page responses to that, which isn't necessarily helpful. But here, as in the rest of the world, what gets measured gets done. And I think we can have a real impact if we just keep prodding everybody and asking questions and taking those climate-reducing steps.
What gets measured gets done. That's a key takeaway. I totally concur with that one. Ian, a few challenges there for investment consultants. You should pick that up.
Yes, thank you, Alex, and thanks, Naomi. Quite right to challenge the investment consultants. As we heard from Jason earlier, managing climate risk, part and parcel of trustees' fiduciary duty. So your investment consultants, myself included, we should be all over this. So whether it's the longer term physical risks from global warming or those more immediate transition risks, the sort of things we saw with BP writing down their balance sheet by 17.5 billion earlier this year, those risks, those transition risks from moving to a low carbon economy, there's a lot for trustees to be doing and thinking about here with their investment consultants, of course. So sort of going to the question, for me, the key hurdle on climate risk, probably like Naomi, has been to move this up the agenda of trustees. And so the way I would suggest a good start point for you all is to just start with, what is your risk? Let's understand it. And here are some practical actions I think you can take to get you on a good footing there. So the first is carbon footprinting. You can get information on the carbon intensity of your portfolio. Similarly, fossil fuel exposure, helping to reveal the risk of stranded assets there. Another approach which I've used with trustees and very much like is the Transition Pathway Initiative study, which identifies for the really highest emitting companies around the globe to what extent your investment managers invested in those, and to what extent those companies are aligned with the goals of the Paris Climate Agreement. So that gives you quite a good picture quite quickly as to just how your portfolio is shaping up with that transition risk in mind. The other practical step, which we'll see more of through what the DWP consultation is proposing, is scenario analysis. LCPs develop that already for clients, and so you should be able to see that from your investment consultants as well. What that means is looking at how your scheme's investments could be impacted by a scenario like an orderly transition to the maximum global warming target of the Paris Climate Agreement of sort of trying to get below 2 degrees or less. What impact would that have, that transition, that quite rapid transition from where we are now, on your investment portfolio? And similarly, what happens if governments don't take action and we're on target for 4 degrees warming in the next 50, 100 years? That's big physical risks. How does that impact your portfolio and your funding level in DB? So some suggestions, practical suggestions on getting that risk analysis to engage the trustees, start to work out what your risk management process is going to be. And then from there, what actions might you take with your investments? Do you need to take action to address that risk? Perhaps more engagement and monitoring of your managers regularly. So the final point I would just finish on is, as Naomi's mentioned already, the products out there for pooled funds particularly, because I know that's a particular issue for most trustees, have been evolving rapidly. There are some very good products starting to come to market now, which engender that alignment with Paris goals. So I think this is an area to move up on.
Fantastic. Thank you, Ian. So we have had a few really interesting questions come in. So I'm going to pause my set of questions to look at some of those right now. So one, I'll put them up on the screen in front of you. Any advice if members wish to invest positively? For example, they want to invest in Black-owned businesses. This is probably a legal one. Jason, do you want to pick that one up?
Yeah, thanks, Alex. Yeah, it's a good question. And I guess my answer goes back to some of the comments I made earlier. And obviously, I'm putting this in the context of what the current law says. Under the current law, I think for a question like that, you have to focus, if you're looking at direct investment, on whether there's the financial grounds for doing so. That takes you back to the analysis of trying to, is there an analysis to help you support that? Or secondly, considering whether to look at this as a non-financial ethical factor. And then I go back to, you have to meet the two tests I described earlier, the member views and no detrimental sort of financial impact. If it's more indirect investment through your managers, clearly there are issues which you can and should raise with your managers, asking them sort of similar questions.
Brilliant. Thank you. Had a few questions in on DWP, TPR, those kind of things. Let's push this one up to the screen. What did the panel make of the DWP's latest proposals for initially larger schemes to set metrics and targets to carry out climate-related scenario analysis? Are they confident that schemes, asset managers, investment consultants are ready for that and compliant? I think, David, this is probably one for you initially, but happy to take other people chipping in.
Sure. The short answer is I'm not particularly confident that most pension funds and most asset managers are ready for this. What I find particularly odd is that pension funds are being asked to do this and asset managers currently aren't. So it'd be mandatory for large pension funds above $1 billion, staggered in terms of when they have to do this, but not for fund managers. And to be honest, most pension funds will be getting the data from their fund managers and from the underlying companies, to whom it also currently isn't mandatory to do this. So while I think it is a good idea, I think pension funds need to be reporting on how they're addressing climate change risks and reporting in line with the TCFD, which is what this is, the Task Force on Climate-Related Financial Disclosures, which is what this DWP consultation is basically pushing for. I think it's coming our way and we have to recognise that. I do think that DWP needs to think about, and other regulators need to think about, how the rest of the chain can support pension funds in actually delivering this.
Understood.
I would just
Thank you for that.
add to that. I think there are clear challenges, but some of them are easier to overcome than others. So in listed equities, which can be a large part of most DB schemes investments, that's relatively easy to come up with the carbon emissions metrics that the DWP are proposing. And similarly on fixed income, it's where you get into the private assets and sovereign bonds that these things are a lot more challenging. So nice to see that the DWP in their consultation does recognise some of those challenges, and there is this as far as able clause available. So I think we're expecting over the next, certainly the 4 years, greater pressure on the managers to come up with that data and make things easier. Investment consultants like LCP are already on top of a lot of these things in terms of helping to measure metrics, but it's just getting the data at the source that is, as David said, a real challenge.
Understood. Thank you. So we do have a few other questions that have come in, but I think for now we'll just move on to my fourth of 5 questions and maybe come back to more questions later, particularly because stewardship by trustees is often questioned. How should trustees be voting, engaging with the funds they hold, and also, should they be divesting? We've already talked about. So the question is, what practical steps can trustees take to exercise those ownership rights? David, over to you first, please.
Thanks, Alex. I mean, I'll start off by saying USS is slightly odd in this context, in that USS, the pension fund, has an in-house responsible investment team and in-house fund manager. So we do the stewardship, we do the engagement, we do the voting for the trustee directly. Most pension funds aren't like that. Most pension funds will be employing external asset managers to do that for them, both the asset management and the stewardship and voting. So I'm going to focus my conversation, my response on that side. USS itself does have external managers, both in public and private markets. So we have developed processes for both appointing them in terms of due diligence and how they address ESG, but more importantly, in terms of monitoring what they do as well once they've got our money. Because they're all very good at selling us a good product, and then they're less good at telling us exactly how they are delivering on the ESG side. Just to be clear, our statement of investment principles does highlight that our ESG policies apply to all our assets. So of course that must include our external assets as well. So what do? We have a detailed process for monitoring our managers, some of which is available online publicly if people want to have a look at that. But what we do is we expect our managers to be able to explain, with their stewardship activities, with their engagement activities, with the underlying assets that they hold, what the aims of that engagement are, what they expect the outcomes to be, and what the actual outcomes of that engagement are. People are very good at talking about processes. We've engaged with 500 companies. We've sent 200 letters. What has the change that engagement, those letters, actually led to? If otherwise, it's not particularly productive. We also expect managers to collaborate with other managers or other asset owners, other pension funds. That's a far more effective way of generating change within companies. So as an example, USS is part of an engagement under something called the Climate Action 100+, where we and a small number of other pension funds and asset managers have been engaging directly with Shell about its position on climate change, its alignment with the Paris agreements. And the outcome of that engagement was earlier this year, the company agreed to be net zero by 2050, with some caveats, but well along the way to achieving that target. Sorry, it's committed to, has an ambition to achieve that outcome by 2050. You should also expect your managers to respond to what you want them to report, not necessarily give you the report that they want to give you. Fund managers often will have a set of presentations that they come to a meeting with, and they'll run through that very glossy set of figures and pictures, rather than focusing on what you might think are more material issues. So it's important that either the trustee or their consultants have specific questions that they want answered, rather than relying on the managers themselves to dictate what they want to tell you. Because what we've found in our monitoring and our questioning of managers is that they will often give us generic information that bears no relation to the actual fund or mandate that we've given them. So we've had generic voting and stewardship data for a public equity fund for a debt portfolio. So you have to make sure that they're not just giving you the waffle that they want to give you, and they're responding to what you need to know for your assets. On voting, we expect managers to be more transparent than they currently are. USS is able to publish its voting data online, so in a searchable database that our members and other interested parties can see. It baffles us that large fund managers can't do that as well. And there should be an expectation that they do that. We have a large manager who provides us their voting data in a PDF, which is unsearchable and has many pages of data that you have to trawl through to find the information that you might be interested in. It's got to be better than that going forward. They should also be able to tell you how they voted on specific resolutions at companies, because they're using your vote at those AGMs, and they should be able to describe why they've taken decisions to get there. As an example, and getting back to the Shell engagement again, because we've been engaging very heavily with Shell on their position around compliance, alignment with the Paris Agreement, there was a shareholder resolution at Shell for the company this year, which requested them to be aligned with the Paris Agreement. We voted against that, much to the annoyance of a group of our members. But because we were in a detailed engagement with the company, we felt it was better for we thought they were better aligned with the Paris Agreement than the member group did, and we explained that. We expect our fund managers to be able to explain their voting positions on similar issues as well. I think it's worth noting that almost all the conversation I've been having now has been around public equities. We don't just invest in public equities. We have to, as pension funds, expect stewardship across all our asset classes. So that includes fixed income, that includes our private equity portfolio, that includes our direct holdings. So you should have that expectation of your managers, whatever the asset class is, to be able to tell you how they are managing their stewardship, their oversight of the underlying assets in the portfolio. And one final thing, there's a new stewardship code that was released last year, and people and funds can start reporting to by the end of March next year. Our expectation is most fund managers should be signing up to that, or at least delivering what the requirements of the stewardship code are. So that will be a firm question in our ongoing monitoring. Are you signatories to the stewardship code? Thanks.
Yes, fascinating. Thank you. Ian, can I get some thoughts from you?
Yeah, I'm going to keep it brief because I can see we've got a lot of interesting questions coming in from the audience. So I'm going to just say a couple of things on this. The first is that just today we've had the PLSA put out the much needed template on collecting voting data from your managers. So it's on their website. Go and grab that. That'll address a lot of those concerns that David was talking to about making sure you're picking up data, or your managers sending you data that's relevant to the funds you're investing in. and demonstrating where they're voting on significant votes. So that's really helpful. The other point I just wanted to leave you with was a proactive step that I've seen used and I think is very effective for getting into what your managers are doing. And that's on a quarterly basis, make it 6 monthly if that's how often you meet. Write to your managers and ask them how they're responding on certain topical issues in voting and engagement, to see how they're actually responding on the ground. So that might be something like gender pay gap reporting, as one of the questions alluded to earlier, the proportion of black members on the board, board diversity more generally, climate change issues. Just by raising those questions with your managers on a regular basis, you start to get an understanding of how they're dealing with these things, and get comfortable or not that the manager's doing what they should be.
Fascinating. Thank you. Yes, as you said, we have got a lot of really interesting questions coming in. Let's do a couple of those now. So first of all, I think this again is probably a legal question. Do panelists know of any schemes that have been taken to court by members as a result of not properly considering any ESG issues? I'll start that one off with Jason, but others shout if they are aware of something.
Yeah, thanks, Alex. So in the UK, not anything, I guess, specifically on this just yet. We are seeing and have seen some court cases that sort of go around the topic. So in the local government context, there was the Palestine case earlier this year. And increasingly, I think we will get members raising issues. As to whether or not they end up in court, we'll see. But you can see that it might only be a matter of time, given the way in which the legislation is tightening and disclosure requirements mean greater transparency. And then the other thing I'd just say, Alex, is what we are seeing more of, though, is sort of collective membership, sort of letters into trustees and or organisations like Client Earth, putting trustees of pension schemes under pressure in terms of what they're doing. So whether it's into court necessarily, maybe not just yet, might come, but certainly seeing increased pressure from the outside world.
Just to add to that, one Australian super is currently going through the courts where a member has taken their trustee to task over failure to address climate change risks in the portfolio. So that's still going through. And bearing in mind that their legal system is fairly similar, and pension structure, albeit all DC, but pension structure is quite similar to ours. So it's being looked at as a kind of a test case in Australia.
Yes, very much aware of that one, David. Thank you. Thanks for raising that. It's very important. Actually, while we're with you, David, I think this question might be for you as well. Within what we might call ESG circles, discussions have started about the impact on corporate culture, short-termism at a board level, and indeed executive pay. Is that the kind of engagement that you're having with the shareholders?
So as engaging with companies on executive pay is high on our list of particularly voting activities. So we always get a vote on exec remuneration every year, and every 3 years there's a vote on the strategy. We have quite a robust view that executive pay should be linked to performance, and it isn't always necessarily the case that it is. So we have quite a strong voting policy that pushes back on that. And our voting data is actually made available in our annual report. And as I said, we have a database that people can search on them. So short-termism is an ongoing issue, both in terms of corporate and the investment sector in general. There's a lot of pressure on fund managers and pension funds for returns. And if markets are going against us, there's pressure for decisions to change. And I think that's something that should be avoided. We should be taking long-term investment decisions. Corporates should be taking long-term investment decisions and perhaps riding out some of the short-term pain that sometimes companies have to go through.
Absolutely, particularly at the current time. Thank you. Some of the other questions that have come in, I think, are actually answered by my fifth and final question. So I'm going to push that one out there, which is around about jargon, really, and how do we cut through that? And the question is, how do you differentiate between what's really good ESG and what is simply greenwashing? Ian, can you kick us off with that one?
Yes, thanks, Alex. As we've heard, industry is rife with jargon and three-letter acronyms like ESG. So it's easy for the investment managers to sound impressive, but fall short of good ESG practice. And equally, consultants can be accused of the same. So in part one of the webinar, I talked about the characteristics we look for in a manager that we see as genuinely integrating ESG. So I'm not going to repeat that here. Instead, I'm going to keep it short and I'm going to keep this practical for you. And I want to start with looking at just, what's some hard data on what your manager's doing. So let me just put up our ESG dashboard to illustrate what I mean by this. And this shows on one page the key metrics for a fund that you might be invested in, as an example fund here for developed equity fund, and how that would compare to the wider benchmark, in this case, the FTSE Developed Index. So looking across the top line, you can see it gives scores for the three pillars under environmental, social, governance, and overall. These are scores out of 10, with the higher score being better. So here's the practical bit. Let's say, for example, you've got this type of dashboard for your fund. It's got a very low score on governance relative to the wider benchmark. Automatic question, why is that? Can your manager explain why and what they're doing to improve this? And it could be, for example, they've got a big investment in a company that's lacking independent representation on the board, or the gender balance is not good either. So is your manager engaging to address that point? And that's where having the hard facts allows you to differentiate between the managers that are genuine on ESG and those that are just greenwashers. You'll see in the middle of that dashboard, I focused in on climate metrics. As we've heard, really topical right now with the recent industry guidance for trustees on climate change and the DWP's proposed regulations for large schemes. Once again, having that data reported to you allows you to manage and monitor and challenge your manager on climate-related risk. Worth being aware that ESG data like this is by no means perfect. The data providers, at the end of the day, they're relying on information that's been made available to them from the companies. So a good example of that came to light when I met a fund manager who challenged, and I challenged them on the high carbon intensity for their global equity fund. The fund manager in that case knew exactly why the figure was high. His fund was invested in a steel producer, not reporting its carbon intensity. So without that data, the ESG data provider assumed that this company, like other steel producers, burns a lot of carbon. But what that data provider didn't know, because the company wasn't reporting it, is that the company is using recycled steel, has lower energy processes than the average steel producer. So not only was the manager able to demonstrate some good understanding of the management and risk around it, but they also uncovered some hidden value that other investors might not see, and had the opportunity to engage with and help the company on its reporting. So, a very instructive, great example of, having some questions, some good questions based on data for the manager and getting an insight and understanding into what they're doing. You'll see on the chart other parts help bring out concerns around controversies, for example, breaches of the UN Global Compact principles. And again, all these things can just help generate good questions and understanding what managers are doing. So I know David and Naomi are keen to respond on this too. So to sum up my recommendation, arm yourself with data, challenge your manager to help you get an understanding of what it is they're doing to integrate ESG in practice. I'll leave it there.
Yes, indeed. Thank you. David?
Very briefly, it is actually quite difficult. Managers are very good at communicating. As I said before, they have nice glossy reports, and it's their jobs to sell stuff to pension funds, and they are good at it, and they're rewarded for it. They're very good at marketing, but it doesn't mean that their ESG is always up to scratch. As an example, even this week, Professional Pensions had a report out that one of the consultants had done some research and discovered that about 3/4 of asset managers consider climate-related risks and opportunities in their investment processes. However, nearly 40% were unable to provide any examples of how they actually did that. So they say one thing and actually are not delivering on the other side. So that gets back to the points I made earlier. You need good monitoring of what your managers are doing, good interrogation of the examples that you want to be drilling down into, not necessarily of the stories that they want to tell you, and a particular focus on the outcomes of what happened rather than the processes that companies, fund managers have been through. So pension funds should be expecting their consultant support in delivering this.
Yes. And final word to Naomi.
Yeah, I'll just share with you a couple of questions that I have in my back pocket, one for asking fund managers and one for asking investment consultants. So for the fund manager, I like to ask whether the responsible investment team is able to veto the selection of particular stocks for ESG reasons, because that gives you a really good sense of whether their responsible investment team is actually properly integrated. And then for the consultants, it's a bit of a cheeky challenge. I ask whether they would sell rate a fund for ESG reasons, and if not, why not?
Good questions to ask, certainly. In the vein of asking questions, in our final couple of minutes, I'm actually going to cheekily ask a final question of our audience, because I'm just looking forward as to how can we take action on ESG matters, and what's preventing people from taking on these actions for ESG matters. And so I've put a list of options in front of you. Again, you can again select as many as are appropriate, and please do so now. Lack of trustee knowledge, perhaps training, investment consultants that are variable quality, shall we say, lack of suitable investment funds. Perhaps there are simply higher priorities on the trustee agenda right now, COVID, company covenant perhaps being one, or maybe nothing stopping you. That'd be fantastic to hear. You are taking all the action. Select whichever of those apply, and then press the submit button. And then I'm going to try and take one more question as well. So I won't give too long for a response. Let's see what we've got. Great, thank you. A mixed bag is the answer. So there are lots of different challenges in front of us, but definitely a need for more trustee knowledge and training. And that is something that we are very much trying to help trustee boards with, partly through webinars like this, but partly through tailored training courses that we provide to individual trustee boards. Other things on the agenda, presumably things like COVID, makes sense as well. Good to see 40% saying no issues. We're cracking on with it. That's fantastic to see. I think one final question, if I may, to our panel, which is this one here. ESG scores are all very good, but how do we create intentional positive social outcomes that are beyond what would have happened anyway? And I'm going to actually zip all the way through our panel and ask, either answer that question in one line or give me one other action that can make sure we get proper positive action. I'll zip straight around. Naomi, could you give us one action?
I think it's be bold and be brave, ask and do it.
Thank you. Ian?
Stewardship critical to make change, drive change, so retaining some ownership, even if it's small, for those companies that have controversial matters, so that you can drive change within it.
Jason?
Yes, I think pressure, collective pressure on managers, and probably looking for some support on legislative and regulatory change, particularly to the managers.
And David?
expect more of your consultants in how they support you in your stewardship and your oversight of managers.
Thank you. I know we're about to lose you, so I will just wrap up by saying that this is something that's going to run and run, obviously. I found this particularly interesting as part of my development of thinking about what can be done and what cannot be done, perhaps for practical and legal constraints. To the audience, thank you very much for your engagement. Great questions all the way through. Really enjoyed the session. You made my job easy. And for the polling questions, there were another, I don't know, 10 questions we didn't get to, so we will endeavour to get back to you individually. And I'm sure we'd all like to say a big thank you to our presenters for their insights today. One way of doing that is to respond on the feedback questionnaire that you will see as soon as we stop this presentation. So we'd really appreciate your feedback. With that, I will just say thank you and good afternoon.